Nvidia, I got to say, is probably, it has been for years now, one of the most searched tickers on CNBC.com every single day for years now. But it's still a best idea for you. Why?
Absolutely. And we've had it since 2018 and continue to increase positions in it. Why? Because we're just at the early stages of the build out of the infrastructure around AI. It's like we're just laying the track of the Transcontinental Railroad. NVIDIA is the absolute choke point to that. And if we're going to grow AI and what it's going to do for labor productivity at every company in the world, NVIDIA is going to be a key part of that. And so we think that their chips are absolutely essential to growth. We think their chips are absolutely essential to increase labor productivity. And we think that the demand signal for this is going to only get greater over time.
So can investors just thematically invest in strictly artificial intelligence? Because if there are ETFs for that. They just buy a basket of stocks. Or do you have to be more discerning and make a fundamental case as to why certain AI-oriented companies are better values or better risk-reward candidates than, say, others?
We look for the choke points, the companies that are absolutely dominant at a particular place in the supply chain, where they're the ones that have pricing power. They're the ones that are able to get excess earnings out of that. So they're out of this whole big theme. NVIDIA as a company occupies the choke point in this. They get pricing power. They get excess earnings. That's going to deliver better stock price in most cases. So I think that this is where you do want to be a little more discerning. You want to pick the guys that are absolutely essential and occupy choke points.
It's funny because we were just last hour talking about how the retail investors have been selling NVIDIA. We were talking about that with Robinhood. And
at Robinhood, yes.
I said, so if they're selling, who's buying? And now we know who's buying.
Absolutely.
Yeah. So, but your case for the long run is that this company will continue, I guess, to outperform the S&P, even though the past year it's been not so much.
You know, the issue is this theme is not going away. We're in the early stages of this. We're just building out the infrastructure. We haven't even gotten to where we're implementing it across the board. And so when you move to that, this is going to be something that's going to help our economy overall. Every company needs it. You take a look at CapEx spend of Microsoft. You take a look at CapEx spend of Meta. They're continuing to buy what NVIDIA is selling. And NVIDIA is not having to discount anything. And they've got long backlogs.
All right, let's talk about the Magnificent Seven. We know Meta was in the news yesterday, signing this big nuclear power deal with Constellation Energy. Is the mega cap technology comm services trade, the Mag 7 trade, just one you should just go with and let it just ride?
You know, basically, we're at the early stages of this. This is a generational opportunity to increase labor productivity in this country and really worldwide. And so I think you're in this situation. Anybody who's tied to that is going to have very long legs on their growth for a period of time. So yes, it's kind of this is the beginning of the next industrial age, and this is one of the key points to it.
According to reports, Nvidia is getting ready to re-enter the Chinese market after the Trump government banned the company's H20 processor sales there in early April. The announcement caused Nvidia's shares to rise. ZJK Industrial, a company based in Shenzhen, China, said Thursday that it is increasing production to satisfy the rising demand for Nvidia's B40 project. According to a press release from ZJK, the B40 chip is a specially made AI accelerator for the Chinese market. It targets the mid to high-end market sector and is built on Nvidia's Blackwell architecture. According to ZJK, mass production might begin as early as this month. A request for comment on the officially unannounced custom chip was not immediately answered by Nvidia. Nvidia's shares increased slightly to 142.29 during today's midday stock market trading. ZJK's shares, meanwhile, surged almost 9% to 5.28. The company's previous generation Hopper series served as the foundation for Nvidia's previous AI processor for the Chinese market. However, for security considerations, the U.S. government prohibited the H20 chip's sale. Nvidia CEO Jensen Huang stated on a May 28th conference call with analysts that the business was looking into ways to re-enter the Chinese market. However, it seems that ZJK was the first to inform Chinese consumers about the new CPU. Precision fasteners and other metal components are produced by ZJK for a range of industries, including automotive, aerospace, energy storage, medical, electronic equipment, and liquid cooling systems for artificial intelligence supercomputers. According to the news announcement, ZJK chief executive Ning Ding stated that the B40 project offers a number of strong market benefits. It enhances the RTX Pro 6000 workstation graphics cards from Nvidia, which are presently offered for sale all around the world. By the end of 2025, supply chain projections indicate that shipments of B40 chips will have surpassed 1 million units. Charts show that Nvidia's stock is getting close to a 153.13 purchase point out of a 22-week consolidation pattern. So, what implications does this have for Nvidia stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now, let's get back to the video.
Jessica, I want to start out with the first stock on your list, Nvidia. Look, it's had quite a run over the past month, gaining more ground today. You had Jefferies adding it to his list of highest conviction picks today. Tell me your view here.
Yeah, Diane, we left off last week. We were looking for a reacceleration of demand, and that's exactly what we got from Jensen Huang, and also broader adoption. I read this really great report where 78% of global companies utilize some shape or form of AI, and that was from McKinsey. So there tells me there's broader adoption. Where is that acceleration? And he gave us about 4 reasons. One, inference and reasoning AI. Obviously, we're way beyond just purely utilizing it for chat. That's ignited exponential demand. Inference costs are coming down. That was a big headwind when we had this integration or DeepSeek came out. However, there's still demand. So that's actually good. That's driving efficiencies. And that's what I think we need to follow. Global AI and infrastructure build out's the second one because of the administration's really fiscal policies. The diffusion rule was lifted, which means there is broader adoption that could happen on American-made AI stacks. I think the headwind for that we really need to watch, though, is with China integration. Jensen Huang said himself, so as those negotiations are happening between the administration and China, I want to see how AI plays into that. According to Jensen, there's 50% of AI developers are there. And as we've seen with the broader large language models, those that are open source tend to really accelerate in their growth. So I want to see that access to China, but we want to see them built on American stack. That's Jensen's words, and that makes sense to me. Third is enterprise AI stack integration. Again, agents are working really, really well. They are great enterprise use cases. And then industrial AI and robotics beyond that. We're seeing that even with Tesla and their self-driving models. All of these 4 things hang on demand from NVIDIA itself, which I think would reaccelerate that AI narrative. Of course, the broader macro theme could be a headwind. Lots I said there, Diane.
Yeah, no, but I understood what you said, even especially the point about agents taking over. And one day, who knows, maybe our agents or digital twins will be talking to each other. All right, but this is the
most well-known competitor of Nvidia in the competition to drive artificial intelligence research in China is Huawei Technologies. However, despite growing interest in domestic solutions, a report from The Information claims that the Chinese tech behemoth is having trouble gaining momentum with significant domestic consumers. Due to U.S. export constraints, Nvidia CEO Jensen Huang has openly warned of Huawei's expanding capabilities and the general pace of China's chip research activities. However, despite tighter supply of Nvidia's products due to U.S. trade restrictions, ByteDance, Alibaba, and Tencent Holdings' looted ADR, 3 of China's leading AI companies, have not yet placed substantial orders for Huawei's Ascend chips. The information was informed by a number of workers from top organizations that Huawei is having a hard time convincing some of the biggest tech companies in China to use its chips. Chinese company leaders and engineers have expressed worries about Huawei's hardware's performance issues and their anxiety about breaking U.S. trade regulations. When compared to NVIDIA's industry-standard CUDA platform, tests conducted by companies like ByteDance and Alibaba showed that Huawei's Ascend 9110C chip overheated and had restrictions in its software stack, CAN. The cost of transitioning from NVIDIA to Huawei would also be considerable, necessitating a rethink of the software, engineering procedures, and data center infrastructure. According to executives, Huawei must adjust to its platform if businesses are to migrate to its processors in large quantities, while others keep a careful eye on Huawei to see if an ecosystem can emerge around its chips. Some developers, like DeepSeek, may be crucial in determining the company's future. DeepSeek will draw a lot of open-source developers to build their models on Huawei's ecosystem if it is prepared to widely use Huawei's hardware and software for AI training. However, that isn't the case right now, according to Qingyuan Lin, a semiconductor analyst at Bernstein, who was quoted by The Information. By connecting up to 384 Ascend processors, Huawei's new AI compute solution, Cloud Matrix 384, aims to make up for the performance of individual chips. However, there are technical issues with the system, such as its high power consumption and lack of native support for FP8, a low-precision integer format that is necessary for advanced AI training. Another geopolitical issue is that businesses who use Huawei's cutting-edge AI processors could face substantial criminal and administrative penalties as a result of a recent warning from the U.S. Department of Commerce. At least one Chinese data center company has already canceled a tentative order for Huawei technology as a result of this. Huawei has achieved significant sales to local governments and state-owned businesses in spite of these challenges. However, as regulatory pressure increases on both sides of the Pacific, leading Chinese IT companies do not appear to be planning to leave Nvidia, whose products continue to dominate high-performance AI systems. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now, let's dive into today's video.
Rick, take us through what you're paying attention to when it comes to the chart for Nvidia.
So the chart for this one, we're at a potential turning point here, a key resistance level. If we were to look at our current price, you can see we topped out recently near 143, 144 or so at this red line here that represented a high point and then a low point and then another high point here after our initial fall that took us to our purple 250 two-day exponential moving average. So this level, 142, 143, that is a key point. That's about where we're sitting right now, just below that point, a hair below 142. So for now, though, we can see that we've had a sharp rally off of these lows, 86.62. We're up about 63, 64% from that point here. So it's been a very swift turnaround after the tariff news-related turmoil that sent stocks so much lower here, but rebounded very quickly. For now, though, we can also see the 130 level sticks out here. This green line, a repeated stopping point for price during the past year. High points here, low point, low point, low point, low point, etc. So now it also lines up with our yellow 21-day exponential moving average, a shorter-term moving average commonly followed by many traders. So that would be in confluence with that key price level. So an important downside area to watch in the shorter term. We can also see RSI, our measure of momentum, has been fluctuating lately. A little bit of bearish divergence here as price made a new closing high, but RSI went downward here. Seems to be on the verge of being invalidated. If RSI were to break above this trend line, it would not only invalidate the downtrend, but it would also push back into the overbought area, typically regarded as a sign of strength in a trending market here. So now, if we were to look at our volume profile study, we can see that the area where we're passing above right now, this is a heavy volume node area between about 132 to 138 or so. So that's more important news for the bulls, that price is hanging on above this key consolidation point that also lines up with our +1 standard deviation channel, which many traders use to project support or resistance here. If we do keep moving upward, the +2 channel comes in near 151. That could be an upside area to watch. But this general level, 130, would be the extreme low point, lining up with our moving average, a key downside area for traders to watch for support.
Okay, Jessica, want to send it back to you for final thought on Nvidia before we get to your next stock, especially in the context of what Rick was saying about paying attention to RSI fluctuating there.
Yeah, absolutely. I love the way Rick and I have discussed this as well, that he utilizes RSI, because I think so many people use it the wrong way. It can validate that trend if it's in the overbought territory, as long as it's making higher highs with the underlying security that we're analyzing. So I'm certainly looking for that. And I'm also looking at that relative to the overall market as well. NVIDIA is a big piece of the macro narrative at the S&P 500. However, the macro narrative is not just growth, and it feels a little narrow right now. So I want to see validation, but then I also want to see what that looks like more broadly.
Okay, well, as things stand, NVIDIA now outperforming
It's time now for today's strategy session. As investors await key catalysts for stock gains, Wall Street is bullish. Analysts at Barclays and JP Morgan both calling for more gains ahead. So how much upside is there? Joining us now, Michelle Schneider, MarketGauge.com's chief strategist. Michelle, it's great to have you on this morning. Talk to me about what you are foreseeing when it comes to how much more room to run the market has without a clear key catalyst in sight.
Well, certainly the milestone of 6,000 is something that everybody's excited about. And we can see that the SPYs and the Qs are really close to their all-time highs. So that's when I like to watch what I call the inside sectors, actually a phrase coined by Stanley Druckenmiller. And that would be the retail, the transportation, and the small caps. And they have a lot of catching up to do. Currently, if we're looking at IWM, the high was 224. It's trading around 214. Not so bad. Transportation, though, really lagging behind that. And interestingly enough, although retail has been leading lately in those inside sectors, it's still almost 30% away from its all-time high that was made in 2021. So there's a couple of things to be aware of, and that is, it's great to see the growth stocks go, and we've seen this over and over and over again. But we really need to see things that will actually stimulate the economy participate. And of course, that would be manufacturing, most importantly, the consumer, and then how robust goods and services are moving. And we're not seeing that yet. So I'm cautious here in terms of adding risk.
You know, one of my favorite technicals to track is a very simple one, and it's just the moving averages here, especially trying to get a gauge of the 200-day moving averages versus the 50-day moving averages that we're seeing. And as of right now, on the 200-day, this market is relatively split in terms of the companies that are trading above or below. It's almost 50-50, but the 50-day moving average a little bit more weighted to trading above that. I wonder from a technical analysis perspective, what your key technical indicator is that you're watching right now to really get a gauge of where spirits are transpiring and sentiment within the market.
Well, first of all, I love moving averages and I love the 50 and the 200. So let's just broaden out that time frame a bit and go to the weekly moving averages. And that's really where I think is most interesting right now. So for example, semiconductors, they're back over their 50-week moving average. And the 50 is above the 200, which is also important. You want that positioning to show more of a bullish edge, and it is. The same thing with retail. It got over its 50-week. That's really encouraging. So I'm certainly not trying to be negative. I'm just trying to look out. And then if you look at the small caps, they're below the 50-week. If you look at transportation, it's below the 50-week. And regional banks are sitting right on it. And I like to look at the regionals as opposed to the actual big banks, and I know you mentioned the financials in the beginning. So, and biotech, by the way, is just under everything. So that has a lot to do to prove that it can come back. That's what I'm looking at, because from a weekly standpoint, we need to get those things back into these bullish weekly phases, and we're halfway there.
Let's talk about the tech sector within that context as well, because if you look at the 6-month price chart for all members of the Mag 7, the only one trading below its 50-day moving average is Apple. How does that frame how you're thinking about those Mag 7 stocks right now?
Well, interesting about Apple, because remember, Apple used to be the thing that led the market, right? So if Apple was up, everybody felt very bullish, and now, of course, it's fallen out of bed for its own reasons. In terms of the rest of the Mag 7, yeah, I mean, it was such a gift back in April after we saw that big washout and things started to come back. And using Brad's 50-day moving average, especially when they were clearing the 50-day moving average, if we're looking at Nvidia, I'm a little bit concerned about piling in right now in that area. I think there are other areas of the market that are far more interesting to me that have a much more limited risk and a much greater upside potential.
Mish, while we have you here, I just got a note that came across from UBS in my inbox, and they're talking specifically about stability and how the markets should be evaluating stability in the U.S.-China trade relationship here as negotiations continue to move forward. What most notably would be the needle mover for you to really get a sense of how much the volatility that the markets have had to endure tied to this relationship is in the rearview mirror, and that there's just more of a prospect for stability that some of the larger institutions trading are looking at right now?
Well, I believe that it's already in the rearview mirror and has been. So now it would have to be something really dramatic like they don't come to the table and Trump goes back to threatening huge tariffs to shake the market up. I think the market is anticipating anyway the worst is over. So that's kind of how we're going. The tariffs are there. I think the biggest impact of the tariffs right now is that we haven't really seen how they will reflect in price as we're going into some of the inflation indicators, PPI, CPI this week. And I think that's what you have to keep an eye on, especially since you're looking at a lot of commodities here. Listen, if China and U.S. play nice, that would be good for commodities. If they don't play nice, that may also be good for commodities. And that's why I don't like anyone to forget that conversation right now. That's where there is a tremendous potential opportunity. Not only could we see both the market and commodities go up, but we can also see at some point that split. So China's there, but it's more about how cooperative they are and how much they're going to need from us. They've already split to other areas or not. But I'm not too worried at this point.